Welcome to the Deep Dive. We're jumping straight into SoFi's Q3 2025 results today. Our goal, to really unpack these record numbers, look at management's supercharged guidance, and figure out what's driving it all, especially with AI and blockchain in the mix.
Yeah, we've got the key docs lined up. It really looks like a platform hitting its stride. Let's kick off with those headline numbers because honestly, they paint a pretty clear picture.
Absolutely. When the results came out, everyone seemed to notice the top and bottom lines growing together. Adjusted net revenue, a record $950 million. That's a massive 38% jump year over year.
Right.
But revenue growth alone isn't the whole story, is it? Efficiency matters.
Yeah.
And here, Adjusted EBITDA hit $277 million. That's up 49% YoY, giving them a really strong 29% Adjusted EBITDA margin.
And what's really important here, I think, is that this isn't just some adjusted figure magic. This is actually their 8th straight quarter of GAAP profitability, the standard accounting measure.
8 quarters, wow.
Yeah. GAAP net income was $139 million, a solid 14% margin. And if you look at what the analysts were expecting, they blew past that too. Adjusted EPS came in at level 11 cents, well ahead of the Zacks consensus of layer 9 cents.
So they're not just growing, they're getting more profitable as they scale?
Exactly. They're converting more of that revenue into actual profit.
Okay, so Q3 looks really solid. But honestly, the part that caught my eye was the forward guidance. Management seems incredibly confident. They didn't just meet, they raised the outlook for the whole year, right?
Yeah.
How aggressive are we talking?
We're talking really aggressive. It feels like a huge vote of confidence from inside the company. They pushed the full year adjusted net revenue forecast up to about $3.54 billion. That's up from $3.375 billion before. It points to like 36% growth for the year.
Okay.
And adjusted EBITDA, they raised that target to around $1.035 billion, up from $960 million. Hitting that billion-dollar annual EBITDA mark, that's a huge milestone for any fintech.
Definitely a big psychological number. But if we're searching for the single clearest sign of their confidence, the number that says, this isn't just a fluke, what should we be looking at?
That's got to be the tangible book value, the TBV. It's basically their net worth, right? What's left if they paid off all debts. Think of it as their safety cushion.
Okay.
They massively increased the expected growth in that cushion for the year. They now expect TBV to grow by about $2.5 billion. Before, they were only projecting $640 million.
Hold on, $2.5 billion up from $640 million. They basically quadrupled their expected safety buffer growth.
Pretty much. It's a huge signal. The TBV itself grew by $1.9 billion just in Q3, ending at $7.2 billion. When a company does that, boosts its outlook for its core safety net so dramatically, it tells you the underlying business is just generating cash way faster than even they expected.
Right, that makes sense. That's the foundation for everything else.
Exactly. Stability, future growth, everything.
Okay, so the capital base is growing incredibly fast. But you need customers to make that capital work. How's that financial services productivity loop, the FSPL engine, doing in terms of bringing people in and maybe more importantly, getting them to use more stuff?
Yeah, the FSPL seems to be really clicking now. You can see the network effects. They added a record 905,000 new members. That brings the total up to 12.6 million, which is 35% growth year over year. And products kept pace, added 1.4 million new ones. Total's now 18.6 million, up 36%. So the raw growth is definitely there.
But the key is getting those existing members to add more products, reducing acquisition costs, right? How's that cross-buy looking?
That's where it gets really interesting. Cross-buy hit its best level since 2022. 40% FORMU of new products in Q3 came from existing members. That's up quite a bit from 35% in Q2.
Okay, 40%. That's significant.
It really is, and it directly feeds into their push towards capital-light revenue, that fee-based income. It hit a record $409 million, up 50% year over year, and now makes up 43% of their adjusted net revenue.
Got it. So that high cross-buy explains why the non-lending parts of the business are becoming so dominant.
Absolutely. If you bundle together financial services and the tech platform, basically, everything but lending, they brought in $534 million. That's up 57% year over year.
So more than half their revenue now comes from non-lending.
57%, yeah, that's a huge shift. That's diversification. That's durability.
And this all feeds into that metric people watch, the Rule of 40.
Right, the kind of benchmark for high-quality growth. You add the revenue growth rate and the EBITDA margin. For Q3, SoFi hit 67%.
67, that's way above 40.
Yeah. And the really impressive part is the consistency. This is the 17th quarter in a row they've beaten that Rule of 40 benchmark. That's over 4 years of delivering profitable growth through different economic cycles. It shows the FSPL model is, well, battle-tested.
Okay, let's break down the pieces driving this. Starting with lending. Huge origination numbers, but you mentioned something about a capital-light approach within that.
Yeah, total originations were a record $9.9 billion, up 57% year over year. Personal loans were the biggest chunk, $7.5 billion. But here's the clever part. $3.4 billion of those personal loans weren't held on SoFi's books. They were originated for third parties through their loan platform business, the LPB.
Ah, the LPB. So that's like a fee generator, right? They make the loan happen but don't use their own capital.
Precisely. They act like a broker, basically. They originate, take a fee, and pass the loan on. It's pure high-margin fee income without tying up their balance sheet. That LPB is now running at a pace of over $13 billion in originations a year, generating something like $660 million in annual fee revenue. Super efficient.
Very smart way to monetize applications they might not want to hold themselves. What about the other loan types?
They were strong too. Student loans, $1.5 billion originated, up 58%. Home loans hit a record $945 million. And get this, the home equity loan product, which they only launched about a year ago, did $352 million of that.
Wow, quick ramp up on home equity.
Yeah, it shows the power of that existing member base. They trust SoFi, they see a new product, they adopt it quickly.
Okay, let's shift to the financial services segment. This feels like the core platform experience, the thing that keeps members sticky and drives that cross-buy. What were the highlights there?
This segment had maybe the most dramatic growth. Net revenue jumped 76% year over year to $420 million.
76%.
Yeah. And you can see the FSPL working in how much money they make per product. That annualized revenue per product hit a record $104. That's up 29% year over year. So they're getting much better at monetizing each relationship.
And underpinning all this is their deposit base, right? How stable does that look?
Rock solid. Deposits grew another $3.4 billion in the quarter, hitting almost $33 billion total. And the key stat management shared, nearly 90% of those deposits are from direct deposit members.
Oh, direct deposit. Those are the really engaged users.
Exactly. They're sticky, they use the platform more, and it's a much cheaper, more reliable funding source than, say, brokered deposits.
And we heard talk about speeding up investment in new tech, AI, and blockchain. What's actually coming down the pipe?
The focus seems to be on making the platform smarter, more helpful. They're rolling out something called Cash Coach right now. It's AI-powered, designed to help you optimize your cash flow, make personalized suggestions. It's not just tracking, it's like embedding financial intelligence right into your bank account.
Okay, that connects directly to the tech side. The technology platform segment, Galileo mainly, provides the plumbing for all this, right?
Yeah.
Both for SoFi itself and other companies.
Yeah, that segment's revenue grew 12% year over year to $115 million. The growth there reflects bringing on new, sophisticated clients. They specifically mentioned a new deal with Southwest Airlines for their Rapid Rewards debit card.
Interesting.
And they said 2 other major consumer brand deals are coming soon. So this platform is the foundation not just for their own AI tools, but maybe for future blockchain applications too, like faster payments.
Right, growth is fantastic. But investors always worry about credit quality, especially with fintechs growing this fast. With 12.6 million members, how healthy are these borrowers? What's the actual data say?
The data looks really good, actually. It supports their claim of high-quality conservative underwriting. Charge-off rates actually declined. For personal loans, the annualized net charge-off rate dropped over 20 basis points to 2.60%.
Declined, okay.
Yep. And student loans also dropped over 20 basis points to just 0.69%. And look at the borrowers. Average FICO on personal loans is 745. For student loans, it's 773. These are prime borrowers.
So the idea that they must be lowering standards to get this growth just isn't holding up?
Not based on these numbers, no. Their recent loan batches, the vintages, are performing way better than their historical loss assumptions. That strong credit quality, plus all the capital they've generated, means their overall capital position is really strong. Total risk-based capital ratio is 20.2% at quarter end. The regulatory minimum is 10.5%. They have a huge buffer.
Okay, so wrapping this up, what's the main takeaway for you, the listener? It feels like SoFi has truly transitioned. They're not just a lender anymore. Hitting that billion-dollar EBITDA outlook shows the fee businesses, the capital light stuff, can really carry its own weight now. It makes the whole thing feel much more durable.
Definitely. And that durability lets them invest in the future. Which brings us to that provocative thought management left us with. They explicitly said they're speeding up investment targeting those dual tech supercycles, AI and blockchain.
Right. They made a point that most industries only really benefit from one or the other. Why is tackling both such a big deal in finance?
Well, think about the combination. We just talked about AI with Cash Coach, personalized advice, better engagement. Now, imagine combining that intelligence with blockchain's potential for things like instant, super cheap international money transfers.
Okay, I see. AI for the user experience, blockchain for the underlying infrastructure.
Exactly. Using AI to know the customer better than ever, and using blockchain to potentially rebuild the financial plumbing to be faster and cheaper. Doing both under the umbrella of a regulated bank, that's a competitive moat that could be really hard for traditional banks or single focus fintechs to cross. It really sets the stage not just for next year, but for how finance might look in 2026 and beyond. So the question for you is that dual approach essential for the financial institution of the future? That's what these results really make you think about.